So two very different questions there. The first one is, does what's happening here, the banking crisis, does that feed into economic tightening? Maybe three questions. Does it feed into economic tightening? Which I think that it does. I think we know that people with reduced deposits or those banks that are taking deposits from elsewhere may well be running a slide rule over lending and tightening up some of the criteria they apply. Is the Fed aware of that? I think Powell has made reference to it and has stated that there are a number of ways to achieve what they're trying to do, and one of those might be credit tightening. So I think we are going into that process. Does the market believe that this is therefore a chance for the Fed to pull back? I think we see a lot of back and forth. We've got another two meetings in short order. We're of the view that they are worth listening to. They've been very clear. We think these rates, maybe we don't increase too much more from here. Maybe we add one and pause. Maybe we add one and pull back. But the end result, I think, that really matters is that we stay quite elevated into the end of 2023 and still at a higher level through 2024, the beginning of it at least.
Neil, while we're debating what the Fed does from here, something that struck me this morning, as we've dealt with a lot of good news as bad news and vice versa over the years, if we get another rate hike, whether it's from the Fed impacting US stocks or whether it's from the ECB impacting Europe, would a rate hike be positive or negative for the banks these days? Because, rate hikes were in some ways perceived as great for NIMs, but now we've got this concern over policy mistake and tightening of credit. So how would you perceive now rate hikes for the implications for banking stocks?
Really, really difficult. And I think I would point to what I consider to be the great decisions taken both by the Fed and the ECB in the middle of this crisis. Hard to call it the middle as we don't know where the end is, but right in the depths of what we were seeing with SVB and Credit Suisse, we have seen firm action, we have seen a focus on price stability, and we've seen that read as confidence, where perhaps pulling back would have been read as concern, as weakness in the financial sector. So I think there are limits to everything, but I think so far, continuing this path, focusing on price stability, making sure that you deal with inflation, because if growth is challenged, stagflation is worse, right? So the focus on price stability is being seen as a sign of confidence. The banks face a lot of issues, long-term earnings being one of them, but I think right now it's about confidence, and the rate path so far is instilling that confidence with the very targeted action we've been seeing.